Yes, people, good morning, good afternoon, good evening to all South India student. How are you? Hope so you're good. I'm also good. So guys, today we are going to revise the very IMP topic, and that topic name is the taxation of trust. Trust means charitable and religious trust. So this topic will cover in examination approx 6 to 8 marks. So this topic is really important for your examination. So you have to remember all the provision of this topic. So first part, this topic is applicable for the charitable and religious trust. Now question is that what is the meaning of religious? So religious they have not defined in the income tax, but religious means normally temple, gurudwara, mosque and church and all, that is called your religious. Now what is the meaning of the charitable? So charitable they have given one definition, and if any trust objective is this objective, then that trust will be treated as a charitable trust. Now what is the objective? First is a relief to the poor. Means if any trust main objective is for the relief of the poor. Relief of the poor means food, shelter and clothes. So normally food, shelter and clothes, we can say that if trust is providing that type of facility, then we can say that trust is doing the relief for the poor. Or if trust objective is for education or yoga or medical relief or preservation of the environment, including watershed, forest, wildlife and all, and preservation of the monuments or places of object, like places for the historical places and all, then that will be treated as a charitable. So what is the meaning of charitable? All people please pay attention. Charitable means either objective is a relief of poor or education or medical or yoga or preservation of the historical places, monuments or preservation of the wildlife sanctuary and all, then it will be treated as a charitable. Now guys, there is a one last point, that is the point number G. Point number G says that advancement of any other objective of general public utility. Here this advancement of any other objective of general public utility is like a etc point. Because here there are some specific points: relief of poor, education, yoga, medical, preservation of environment, preservation of the historical places, monuments. There are specific points, but last point is advancement of any other objective of general public utility. Now many people started doing the business and objective is advancement of any other objective of general public utility. So lawmakers made one amendment, and lawmaker says that this advancement of any other objective of general public utility will be treated as charitable only if the business receipt in total receipt of the trust should be up to 20% of the total receipt. What I am saying that, and this point is applicable only for the advancement of any other objective of general public utility. Yeah? There is a one condition. That condition says that in case of the trust, if objective is advancement of any other objective of general public utility, then trust cannot do the business. But trust can do the business, but business receipt should be up to 20%. Means either it is a 20% or less of total receipt, then only that trust will be treated as charitable trust. Otherwise, that trust will not be treated as charitable trust. I can take an example. Suppose there is a one trust. That trust objective is advancement of any other objective of general public utility, and trust gross receipt is 100 crore. And suppose business gross receipt is 18 crore, then it will be treated as charitable. Answer is yes. But suppose business gross receipt is 22 crore in 100 crore, in that particular case it won't be treated as charitable trust in that year. But question is that, is there is need to cancel the registration of that trust? Answer is no. There is no need to cancel the registration of that trust in that year. Obviously that trust will not be treated as charitable trust, but in the next year, suppose that business receipt is within the limit, then next year that trust will be treated as charitable trust, and trust can claim the benefit of exemption under section 11 and 12. Now next part, we are going to start with the exemption, that is 11.1. You know that charitable and religious trust income is normally exempt, but how it is exempt? So section 11.1. 11.1 says that any income derived by trust from the property held under trust, that will be the exempt. Like three income is exempt. One is the 15% of the gross receipt. So whatever gross receipt of the trust, I can take an example. Suppose Tirupati Balaji trust having the gross receipt of the 100 crore in the year. So out of 100 crore, 15% is a standard deduction. 15% is a standard deduction, that is directly exempt. Now out of the remaining, whatever income applied for the charitable or religious purpose in India, that will be allowed as deduction, or I can say that that is treated as the application and that is exempted. So in simple word, I can say that whatever the gross receipt of the trust, out of gross receipt, 15% is a standard deduction, that is exempted. Now second is out of the remaining 85%, whatever income applied for the charitable or religious purpose in India, whatever amount applied for the charitable or religious purpose in India, that will be exempted and remaining will be treated as the trust income. I can take an example. Suppose one trust gross receipt is 20 lakh. So out of 20 lakh, 15% is a standard deduction. So 3 lakh is a standard deduction. Remaining is 17 lakh. lakh. Out of 17 lakh, suppose trust spent the 10 lakh rupees for the purpose of trust purpose for the religious and charitable purpose in India, then the remaining 7 lakh will be treated as the income of the trust, and on that 7 lakh trust is required to pay the tax. Now question is that, sir, you are saying that just take the gross receipt, and out of gross receipt 15% is the standard deduction, out of 85% whatever amount applied for the charitable and religious purpose. Sir, is gross receipt will include the donation also or not? Answer is yes. If any donation received by trust, that will be treated as income derived from property held under trust, and that will also be part of the gross receipt. But guys, there is a one exception, is a corpus donation. If any trust receive the corpus donation, that is totally exempted. That will not be part of the gross receipt. That will not be part of the income. What is the meaning of corpus donation? Corpus is like a capital of the company. In company, you know that there is a capital. So in the same line, in the trust, there is a corpus fund. So if any donation received towards the corpus of the trust, that is totally exempted. That is not taxable at all. So in simple word, can I say that three incomes are exempted for the trust? One is the corpus donation is exempt, but in corpus donation also there is a one condition, that corpus donation has to be invested in the 11.5 mode. 11.5 there are some safe investment mode, and under 11.5 mode that corpus donation should be invested, then only it will be exempted. Now, second is 15% of the gross receipt, that is exempted, and third is whatever amount applied for the charitable or religious purpose in India, that will be exempted. Now, question is that what is the meaning of applied? Applied means expenditure. Either it is a revenue expenditure or capital expenditure, you can claim as an application, no issue at all. Now question is that suppose one trust constructed one hospital, so whatever capital expenditure incurred, can we claim as an expenditure or application? Answer is yes. Any revenue expenditure is incurred, can we claim as an application? Answer is yes, you can claim as an expenditure, no issue at all. Now guys, all people pay attention. Suppose here there are certain explanation, and we are going to discuss the explanation. First explanation says that, yes, sir, suppose for an example, trust recorded some income, and suppose that income trust has not received in current year. There may be possibility that trust follow the accrual system of account. I can take an example. Suppose trust gross income is 20 lakh. In that 20 lakh, suppose there is a 4 lakh income that has not received by the trust in the current year. So obviously when trust has not received the income, but trust already recorded that income, trust already recognized that income. So here guys, in explanation there is a one option. Suppose in your income, if there is any income which you have not received in current year but you already recorded in your income, then guys, trust can give one declaration to assessing officer. Trust can give one declaration to assessing officer up to the due date of return filing, and guys, here trust can give the declaration to assessing officer up to the due date of return filing, and trust will say that trust will make the promise to the AO, sir, this amount we have not received in current year. We are promising you that this amount we will actually applied in the year in which it will received, or in the next year. Then current year it will be treated as deemed to be applied. In current year it will be treated as deemed to be applied, and there is no need to pay the tax. So suppose for an example that gross receipt is 20 lakh, 15% is a standard deduction, 85% is remaining. 85%, it's 17 lakh. Out of that, suppose 10 lakh is actual application in current year. Now remaining is 7 lakh. Now guys, suppose trust has not received the 4 lakh in current year, but they already recognize that income in their income. Then trust can give one declaration to assessing officer up to the due date of return filing, and trust can give the declaration, and they have to mention that, sir, this income of 4 lakh we have not received in current year. We will actually applied in the year in which it will be received, or in the next year. Then in current year it will be treated as deemed to be applied. But guys, in the year in which it will be received, in that year or in the next year, means for next year there will be one bonus year. So in the year in which it is received or in the next year, it has to be actually applied. And suppose if trust fails to apply that amount in the year in which it is actually received or in the next year, then guys, in the next year it will be treated as income, and it will be taxable under section 115 BBI at the rate 30%. It will be taxable in the year in which it is next year of the year in which it is received. So suppose for an example, there was 4 lakh rupees, trust has not received in current year. Suppose trust received that income in previous year 25-26, then it has to be actually applied in 25-26 or 26-27. If trust fails to apply that amount, in that particular case it will be treated as income in the previous year 26-27, because in 25-26 they have received, so in 26-27 it is going to be treated treated as income and trust has to pay the tax at the rate 30%. Now guys, there is a one more option, and second option says that suppose trust could not apply the income in current year due to any other reason. Any other reason means there may be any reason. In that particular case, trust can give one declaration up to the due date of return filing to assessing officer, okay, sir, this amount we could not apply in current year due to some reason, we will apply in the next year, then in current year it will be treated as deemed to be applied. Now, what can be a possible reason, guys? Here, like suppose some major donation or bumper donation received in the end of the year. Suppose for an example, trust received the 10 crore rupees in the month of the March, at the end of the March. So is it possible for trust to spend that much amount within the short span? Answer is no. So here trust will give one declaration to AO, okay, so this amount we will actually apply in the year, in the next year. We will actually apply it in the next year, then in current year it will be treated as deemed to be applied. But suppose in the next year trust could not apply that amount, then in next year obviously it will be treated as income under section 115 BBI and trust is required to pay the tax at the rate 30%. You got my point or not? Yes. Now next part is related to explanation number 2. Now explanation number 2 says that suppose if there is any trust and one trust is giving donation to another trust, then whatever donation is given to another trust is that will be treated as application or not? Answer is yes. If trust give the donation to another trust, then it will be treated as application. But guys, there is one exception, and that exception says that trust, suppose one trust has given the donation to another trust as a corpus donation, then it will not be treated as application. So for an example, our trust name is a Wave Creators, and suppose we made the donation to the Tirupati Balaji Trust. That trust is also registered under section 12 the AB, and we are giving the normal donation, then it will be treated as application for us. But suppose we are giving the corpus donation, then obviously it will not be treated as application for us. You got my point or not? Yes. Now one more point. Lawmaker says that section 40A subsection 3, section 40A subsection 3A and section 40 clause A subclause 1A that we already discussed under the head PGBP, this 3 section will be applicable here also. Now 40A subsection 3 says that if any payment is made more than 10,000 in a single day to a single person, then it has to be made by account pay check or account pay demand draft or any mode of electronic clearing system through bank account. And what is the electronic clearing system through bank account means? Either debit card, credit card, NEFT, RTGS, IMPS, BHIM UPI, QR code. That is called your electronic mode. So if any amount of more than 10,000 is applied in a current year, and that is that amount should be paid by the account pay check, account pay demand draft or ECS mode only. It means if it is paid in the cash, then it will not be treated as the application. And one more point we have discussed, suppose for an example, earlier application is already claimed on the due basis, and in current year suppose trust is making the payment to someone more than 10,000 in cash, then in current year it will be treated as the income of the trust due to section 40A subsection 3A. Now, section 40 clause number A subclause 1A says that if any payment is made to resident, then TDS has to be deducted, and that TDS has to be deposited up to the due date of return filing to the government. If assessee fails to do that, then 30% of expenditure will be disallowed. 30% of expenditure will be disallowed. 30% of expenditure will be disallowed. Now next section is explanation number 3A, and this explanation is added by Finance Act 2022, and this explanation is applicable from assessment year 21-22. Now guys, this explanation says that suppose if trust is having any temple, mosque, gurudwara or church, and they received any donation towards the repair and renovation. Suppose there is a temple, church, mosque or gurudwara, and they receive the donation towards the repair or renovation of that temple, church, gurudwara or mosque. Then guys, trust have an option that trust either can claim that donation as a normal donation, or trust can claim that donation as a corpus donation. And suppose trust is treating that donation as a corpus donation, then obviously there is no need to pay the tax. If trust treating that donation as a corpus donation, then there is no need to pay the tax. But guys, there are 4 conditions. First condition is whatever amount they have received, that should be utilized for the purpose of repair or renovation of that temple, church, mosque, gurudwara only. Second condition, such amount should not be donated to any other trust. Third condition, that donation amount should be maintained in the separate identifiable account. You can say that it has to be maintained, such corpus in the separately identifiable. And last condition is that amount should be invested in the safe mode only, in the safe investment only. If all four conditions are satisfied, then guys, they can treat the donation, whatever they receive towards the repair or renovation, as a corpus of the trust. So what I'm saying that this explanation is added by Finance Act 2022 only, and this is applicable only for the temple, church, gurudwara and mosque. So if temple, mosque, gurudwara and church, if they received any donation towards the repair or renovation of temple, church, gurudwara and mosque, then they have an option that either they can treat it as normal donation or they can treat it as a corpus donation. If they're treating as a corpus donation, then it is totally exempt, as there is no need to include it into the income. But guys, there are four conditions. First condition, that amount should be utilized for the purpose of repair and renovation. Second condition, that amount should not be donated to any other person. Third condition, separately identifiable. And last condition, it has to be invested in the 11.5 mode. Suppose if any condition is violated, then in the year of violation, that will be treated as income of the trust and trust has to pay the tax. Now there is an explanation number 4. Now explanation number 4 says that, suppose guys, trust is having the corpus, and out of corpus, trust withdraws some amount and they applied in the current year. And in current year, they use that corpus fund for the application. Then guys, whatever amount they have applied now, in current year, it will not be treated as application. It will be treated as application in the year in which it is again deposited back to that corpus. It will be treated as application in the year in which it will be again deposited back to the corpus. I can take an example. Suppose for an example, Tirupati Balaji Trust, they are not having the, in the COVID time, what happens? Suppose they are not having the recurring income. So what they did, they withdraw some amount from the corpus and they spend for the purpose of the trust. And they suppose paid the salary of all employee working in the Tirupati Balaji Trust and all. So guys, they applied out of the corpus. Then in the year in which that actually expenditure is incurred, in that year it will not be treated as application. Means you cannot treat it as application. It will be treated as application in the year in which it is again deposited back into that corpus fund. One more point says that, suppose if any amount is applied in current year out of the borrowed money or loan, then it will not be treated as application in current year. It will be treated as application in the year in which it is loan is repaid. So for an example, trust constructed one building in current year for 20 lakh rupees. But suppose they borrowed the 10 lakh rupees in the 10 lakh for the purpose of that building. So can I say that only 10 lakh, whatever remaining 10 lakh will be treated as application in current year? Whatever out of borrowed money they applied, that will not be treated as application in current year. Now, one more point says that, suppose sir, for an example, if any case, can trust income can be a negative or not? Negative means there may be possibility that application is higher than the income. Yes, that can be. So in that case, question is that, sir, whatever the deficit is allowed to be carry forward or not? Answer is no. So for an example, like obviously out of gross receipt, first you will take the 15% standard deduction. After that, whatever trust expenditure that you will claim, and remaining will be treated as the income of the trust. Suppose that remaining amount is a negative amount, then it is not allowed to be carry forward and set off. It is not allowed to be carry forward and set off as per the explanation number 5. Now guys, there is a one very interesting explanation, and that is added by Finance Act 2022, and it is applicable with effect from assessment year 22-23. Assessment year 22-23 means previous year 21-22. It is applicable from previous year 21-22. It means it is a retrospective amendment. Now guys, this particular explanation says that now trust can claim the application only on the cash basis. Trust can claim the application or applied only on the payment basis. Means if payment is not done, then it will not be treated as application in current year. So examiner may ask you the question, suppose trust has spent the amount of the 20 lakh in the current year, but out of the 20 lakh, suppose 3 lakh is paid in the April of the next year. So question is that, is 20 lakh is allowed in current year? Answer is no. Only 17 lakh will be allowed in the current year. So in simple word, I can say that whatever method of accounting followed by a trust, means trust may follow the accrual system, but for the purpose of income, trust may follow the accrual system, but now expenditure will be allowed only on the actual payment basis. Expenditure will be allowed, or I can say that application will be allowed only on the actual payment basis. You got my point or not? Yes. Now there is one very interesting section, 11.2. 11.2 says that, suppose for an example, trust gross receipt was 20 lakh, 15% standard deduction, remaining is 17 lakh. Out of that 10 lakh they already applied. Now remaining is 7 lakh. Question is that, is there is any other option where trust can save the money? Answer is yes. There is one section, 11.2. 11.2 says that, suppose trust wants to accumulate some amount. trust wants to set aside or accumulate some amount for the specific purpose, then trust can exercise the option under section 11(2). So if trust wants to accumulate some income for the specific purpose, then trust can claim the exemption under section 11(2). Now 11(2) says that trust has to mention the specific purpose. Now what is the specific purpose? A specific purpose may be the building, or maybe the temple, maybe the mosque, maybe the library and all. That is the specific purpose. As well as trust has to mention the specific period also. But guys, this period cannot be more than 5 years. Maximum accumulation can be for the 5 years. Third condition is that that amount, whatever accumulated amount, that will not be donated to any other trust. And last condition is that amount should be invested in the safe investment, that is 11(5) more. So if all four conditions are satisfied, then guys, exemption can be claimed under section 11(2), and even amount is not spent in current year, it is accumulated for the future period, and trust can claim the exemption. So what are the four conditions? First condition is specific purpose should be mentioned. A specific period, but a specific period can be maximum 5 years. A specific period can be maximum 5 years. It should not be donated to any other trust, and it should be invested in the 11(5) mode only. Now guys, suppose how you will calculate the 5 year. So for an example, in the previous year 20 to 23, any amount is accumulated, then next 5 year will be counted. Means 23, 24, 25, 26 and 27, 28 previous year. So previous year 22, 23 you have accumulated anything, then from previous year 23, 24, 25, 26 and 27. So 27, 28 will be the last year. Till that time they have to spend that amount for the specific purpose. Now, can we accumulate for the 2 years? Answer is yes. Can we accumulate for 4 year? Answer is yes. 5 year is yes, but 6 year, no, it is not possible. Maximum accumulation can be for the 5 years. Now, one more point, sir, there is a one section 11(3). 11(3) says that in 11(2), if there is any violation, then whatever exemption you have claimed earlier, now again it will be taxable. First is, suppose that amount is spent for any other purpose. Earlier you have accumulated for a specified purpose, but you have used that amount for any other purpose. Then in the year in which it is used for any other purpose, in that year it will be treated as the income. Now second is, suppose that a specific period of 5 years, suppose you accumulated for 5 years and 5 years expired and you have not utilized that amount, then in the 5th year only it is going to be treated as your income. In the 5th year only it is going to be treated as your income. In the 5th year, like you know that till last year there was a 6th year, but now from this year they made the amendment and it will be treated as income in the 5th year only. Suppose that amount is donated to any other trust, then in the year in which donation is made to any other trust, in that year it will be treated as income. And last point is, suppose that amount is not invested in 11(5) mode, then in the year in which violation took place, it will be treated as your income. Now one more point guys, for the calculation of that 5-year period, suppose for an example there is a court stay order of any court. Means suppose that amount was accumulated for the purpose of temple, but some people claim that there should not be a temple, there is a some like suppose religion religious related some case was there and trust could not completed the temple. So in that particular case, lawmaker says that whatever the stay order of the court, suppose court has given the stay, then whatever stay period, that will be excluded while calculating the 5 years period. Now guys, in this section, if there is a violation, then that income will be taxable under section 115 BBI at the rate 30%. So your tax rate is a 30%. After that, section 39 says that if trust wants to claim the benefit of 11(2) exemption, then there are two conditions. One condition is trust has to give the statement to the assessing officer up to the due date of return filing, and they have to file the return up to the due date of return filing. And they have to file the return up to the due date of return filing. Means I can say that this exemption will not be available if a statement is not given up to the due date of return filing, or they have not filed the return up to the due date of return filing. So both activities should be done up to the due date of return filing, then only they can claim the exemption. After that, there is one section 11(4) and 4(a). This says that sir, if trust is doing any business, then on that business income also trust can claim the exemption under section 11 or not. Right answer is yes, if that business is incidental to attainment of the main objective of the trust. If that business is incidental to attainment of the main objective of the trust, then on business income also trust can claim the exemption. But guys, there is a one more condition, that books of accounts of that business should be maintained separately. I can take an example. You know that in the Tirupati Balaji, they used to sell the laddu. So that laddu business is incidental to attainment of their main objective. So it is an incidental business. They can claim the exemption for the whatever income on laddu business. For laddu business, they have to maintain the separate books of accounts. Now, here lawmaker says that they maintain the separate books of account, but when assessing officer was doing the assessment, that time assessing officer realized that there is some concealment of income and assessing officer has increased the income. If assessing officer has increased the income, then whatever on increased part, whatever the on increased part exemption is not available, and in simple word I can say that whatever the increased income by AO, that will be taxable for the trust. So in simple word I can say that suppose for an example Balaji Trust, that Laddu business, they are having the income of 20 lakh earlier. So on 20 lakh they can claim the exemption, means 20 lakh business income will be 15%, 85% applied and all, they can do that. But suppose assessing officer made it to 30 lakh, then remaining 10 lakh will be taxable for the trust. After that there is one section 11.5. 11.5 is related to safe investment. This section says that okay, whatever the trust money na, that has to be invested in the safe mode only, in the safe investment only. Now what is the meaning of safe investment? So safe investment means investment in the government savings certificate or units of UTI or central government, state government security, or debenture of any company which is guaranteed by the government, or units of the mutual fund. Means here trust can invest in the mutual fund also. Equity share of the depository. Depository means NSDL, CDSL and all. Stock certificate as defined in the sovereign gold bond scheme 2015. Share of the NSDC. Shares of the stock exchanges or subsidiary of stock exchanges. They can take the share of the BSC or NSC. Second is deposit with the post office, saving bank, scheduled bank or cooperative bank or industrial development bank. Means trust can invest in the saving bank account or any like post office, saving bank, scheduled bank, cooperative bank, industrial development bank, they can invest. After that they may invest in the investment or deposit in any public sector company also. Public sector company means Indian Oil Corporation, BPCL Corporation, BHEL and all, that is called public sector company where government is having the major holding, that is public sector company. But suppose that public sector company cease to exist as public sector company, then what will happen? For an example, trust has invested in the BPCL, that is Bharat Petroleum Corporation Limited. Suppose BPCL is merged with the Reliance Industries Limited and now BPCL is merged with the Reliance Industries Limited, then what will happen? Because obviously private limited company share, private company share they cannot purchase. They can purchase only, they can invest only in the public sector company. So here lawmaker says that suppose if that public company, that public sector company cease to exist as a PSC, in that particular case, suppose trust was invested in the shares, then guys, from the date of conversion for next 3 years, it will be treated as a legitimate investment. Means it will be treated that for the next 3 years, it will be treated as legitimate investment, but obviously within 3 years, they have to exit from that investment. Now, suppose they were invested in the bonds or debenture and all, then till the date of the maturity, it will be treated as a legitimate investment. You got my point or not? Yes. Now next part is related to investment in the bonds, approved financial corporation, public companies providing long-term finance, or investment in the immovable property. Here trust can invest. Now there is no need to remember these points for the examination purpose. Just you can remember that public sector company, and suppose public sector company cease to exist, then in case of the share for the next 3 years, it will be treated as legitimate investment. And in case of the debenture, bonds and all, till the date of maturity, it will be treated as a legitimate investment. After that, section 11.6. 11.6 this says that suppose for an example, any trust is already claimed the actual cost of asset as an application, then is depreciation is allowed or not? Answer is no, depreciation is not allowed. So for an example, trust has purchased one AC for the 1 lakh rupees, and that 1 lakh rupees they already claim in the application. So is depreciation on that AC is allowed? Answer is no, depreciation on that AC is not allowed as deduction. You got my point or not? Yes. Next section we are going to discuss, that is section 12A. 12A says that sir, 11-12 exemption is available only if the 3 conditions are satisfied. Means 11-12 exemption, whatever we have discussed till now, that is 11 exemption. So this 11-12 exemption is available only if the 2 conditions are satisfied. First condition is that trust should be registered under section 12AA or 12AB. Nowadays registration is took place in the like 12AB. Earlier that 12AA registration was there, but from 1st April 2021, all trusts are registered under 12AB only. So trust should be registered under 12AB. That is the first condition. Second condition, trust income before claiming this exemption is more than basic exemption, then trust is required to maintain books of accounts and get it audited from a chartered accountant. An auditor has to furnish the report up to the due date given under section 44AB, that is the tax audit due date, and tax audit due date is a 1 month before the due date of return filing. So normally due date of return filing of the trust is 31st October. So 1 month before, it means till 30th September, trust audit report should be submitted by the chartered accountant. So all people pay attention. First condition, trust should be registered under section 12AB. Second condition, if trust income is more than basic exemption, means before claiming the exemption, if trust income is more than basic exemption, then trust is required to maintain books of accounts document and get it audited from the auditor, and audit report has to be furnished up to the date given under section 44AB. And third condition is, if trust wish to claim the exemption now, then trust is required to file the return up to the due date of return filing. Means up to the due date of return filing, they have to file the return on the time, then only trust can claim the exemption. Now question is that, sir, trust can claim the exemption from which year? I can say that trust can claim the exemption under section 11 from the year in which application is made for the registration. Means suppose for an example, one trust is created and in the current year you made the application for registration, then from current year your income exemption can be claimed. Means your income can be exempt from the current year. But guys, try to understand, lawmaker says that suppose trust earlier year assessment is pending with the assessing officer. But earlier trust was not registered. Now trust got registered. But earlier year assessment is pending with the assessing officer. And in the earlier year, that trust activity was same and trust objective was same, on the basis of which registration was granted by CIT. Then assessing officer will give the exemption for the earlier pending assessment also. Normally, your exemption under section 11 will be available from the year in which application for registration is made. But suppose earlier year assessment is pending with the AO, and earlier year that objective and activity of the trust was genuine and it was the same, then AO will give the exemption for the earlier year also. AO will give the exemption for the earlier year also. But guys, this benefit will not be available if trust earlier was registered and trust registration got cancelled, or trust made the registration application earlier also, but that application was rejected. In that two cases, this benefit of earlier year exemption will not be available. Now guys, question is that what is the time limit to make the application for registration and all? So guys, there is some changes. Earlier that trust was used to registered under 12AA, but from 1st April 2021, that trust has to be registered under section 12AB. So here we have given the different situation. First situation is related to the transition provision. Earlier that trust was, all trust were registered under section 12AA. Now they have to compulsorily convert into the 12AB. So existing trust earlier was registered under section 12A or 12AA. The government has given them the time of the 3 months from the date on which that amendment came into the force. Means within the 3 months from the date on which this amendment came into the force, trust has to apply online application, apply for 12AB registration. Now 3 months from the date on which this amendment came into the force, so can I say that this amendment is applicable from 1st April 2021? If you add the 3 months, it means till 30th June 2021, all existing trust has to be converted for the 12AB, and they have to make the application for registration under 12AB till 30th June 2021. But guys, after some time CBDT extended this time, and CBDT extended this time till 31st March 2022. So here first point says that time limit for making the application first is for the existing trust. So existing trust has to make the application for fresh like application for transition under 12AB within 3 months from the date on which this amendment came into the force. Now time limit to grant the registration, here commissioner will grant the registration within 3 months from the end of the month in which application was received by commissioner. Means commissioner will give the registration under section 12AB within 3 months from the end of the month in which application was received. And guys, this registration will be applicable for the 5 assessment year, and here they will give the registration without any inquiry. Without any inquiry, and exemption will be available from, exemption is available from the earlier year only, because earlier trust was registered under 12A or 12AA. So exemption is available from the earlier year only, no issue at all. And now this registration will be for the next 5 years. Now in examination, obviously examiner will not ask you this first situation, because this is already done in the last year now. Because now our previous year is a 22-23. This already happened in the previous year 21-22. Now in the current year, this situation number 2 may be possible. Now situation number 2 says that new trust. Suppose one trust is created, new trust is created, and new trust applying for the fresh registration. Then what is the time limit to make the application? So here lawmaker says that new trust has to make the application to the CIT at least 1 month prior to the previous year. 1 month prior to the previous year for which trust wish to claim the exemption. So what they are saying that trust has to make the application at least 1 month before the commencement of the previous year for which trust wish to claim the exemption. So guys, for an example, you may thinking like that, suppose trust wish to claim the exemption for previous year 22-23, then from starting of the 22-23 means 22-23 previous year will start from the 1st April 2022. So before 1 month means is till 28 Feb they have to make an application. Answer is no, guys. Here if you remember little bit in the intermediate also and in the CA final also, in the initial lecture we have discussed that normally your previous year is of 12 months, but guys in case of the new business or any new source of income is arise now, then your previous year will start from the date on which that income is arise or that new business or new activities commence. So in case of trust also, that previous year will start from the date on which trust started the activity. So for an example, guys, suppose in the current previous year 22-23 we have planned that okay, our trust will start the activity, we will start the trust activity from the 10th December 2022. So before 1 month of the 10th December 2022 we have to make the application to the CIT for the registration. So here, guys, in case of the fresh registration, new trust has to apply for the registration at least 1 month before the commencement of the previous year, and here previous year will commence from the date on which trust started the activity. Now, guys, if trust made the application, then CIT will give the registration within 1 month from the end of the month in which application is received by CIT. But guys, here CIT will give the 3-year registration, 3 years registration, and that will be a provisional registration. That will not be a final registration, that will be a provisional registration, and that provisional registration will be applicable for the 3 years, 3 assessment years. And exemption will be available from the year in which application is made. So suppose application is made in current year, then from current year exemption will be available. Now, guys, here CIT will give the provisional registration without any inquiry. He will not do any inquiry and he will give the provisional registration. Now, sir, when trust has taken the provisional registration, then now trust has to apply for final registration also. Then, sir, what is the time limit to apply for final registration? What is the time limit to apply for final registration? Here, lawmaker says that final registration trust has to be applied either within 6 months from the date on which activity is started. Means trust started the activity, then from the date on which trust started the activity within 6 months trust has to apply for final registration, or at least 6 months before the expiry of the provisional registration. At least 6 months before, at least 6 months before expiry of the provisional registration, whichever is earlier time, within that earlier time trust has to make an application for the final registration. So what I'm saying that try to understand, if trust is already provisionally registered, then now trust has to apply for final registration. What is the time limit of final registration? Either 6 months from the date on which a trust started the activity, or at least 6 months prior to expiry of the provisional registration, whichever is earlier time, trust has to apply for final registration. If trust applied the final registration, then CIT will give the final registration within 6 months from the end of the month in which application is received. And guys, here he will make all the inquiries, all detail, all inquiry. He will check that trust activity genuine and all. And after that only CIT will give the registration. And guys, this registration will be applicable for the 5 years. This final registration will be applicable for 5 years, but there is no fresh 5 year. 5 year include that 3 years provisional registration. Suppose 3-year provisional registration was awarded from the assessment year 23-24, then 23-24-25. So 25-26 assessment year. And guys, now final registration for the 5 year, but that will also be counted from the assessment year 23-24. You got my point or not? Yes. Now, next part is, sir, final registration is applicable for 5 year, but again, every 5 year they have to do the renew the registration. Now question is that when they have to apply for renew the registration. So here, guys, at least 6 months before the expiry of that registration, at least 6 months before the expiry of that registration, they should apply for the renew of that registration, and application is made. Then within 6 months from the end of the month in which application is received by CIT will give the registration again for the 5 year. But here also CIT will make the all inquiry, and with inquiry only he will give the registration. Now next part is, suppose trust has changed their object. Trust made some modification, alteration in their object. Then what will happen? Then within the 30 days from the date on which that modification took place, trust has to apply for the fresh registration. And trust applied for fresh registration, then within 6 months from the end of the month in which application is received by commissioner, commissioner will give the registration with all the inquiry, and commissioner will give the registration for the 5 year. You got my point or not? Yes. Point number 6, just skip this. Okay, after that I have given the 1 or 2 example, and this example is related to all registration process only. After that there is a one section 12AB. 12AB is basically procedure of the registration. So whenever like assessee, or I can say that trust made the application, then what CIT will do, how CIT will react. So here guys, point number 1 says that CIT PCIT on the receipt of application shall pass an order for registering the trust for the 5 year in case number 1 of the above. That is a transition mechanism. Now point number 2 says that CIT or PCIT on the receipt of application shall pass an order for provisional registration for the trust for the 3 year in case of the table 2, in case of 2 of table, that is the provisional registration. Now guys, point number 3 says that CIT PCIT on the receipt of application shall call for document and information and satisfy himself about the genuineness of activity of the trust and compliance of such requirement of any other law for the time being enforced by the trust or institution are material for the purpose of achieving its object. Now in this first 2 cases, obviously without any inquiry he will give the registration. One is the transition mechanism, and second is your that provisional registration. Without inquiry he will give the provisional registration for the 3 years. But guys, in other cases, whenever you apply for the final registration, or there is a change in modification and all, or after 5 years whenever you are going for renew, in that particular case what he will do, that he will call for document information. He will satisfy himself about the genuineness of activity of trust. He will check that trust has complied other law or not. Trust has complied other law or not. And after satisfying himself, only he will grant the registration, or he may refuse to give the registration. Or suppose provisional registration was granted, he will cancel that provisional registration in the case of the refusal. Point number 4 says that after satisfying, he may pass order for registration of trust, or refusing the registration, or cancelling the registration. Cancel in case of provisional registration within the time given in the above table. Now guys, there is one amendment, and amendment is point number 5. Guys, suppose for an example, at the commissioner has given the registration to the trust, but after some time commissioner comes to know that trust made some specified violation. Trust made some specified violation, but question is that what is the meaning of a specified violation? So here specified violation means if this 5-6 violation took place, then it will be treated as a specified violation. Which 5-6 violation? First is, suppose where any income is applied for the other than the object of the trust. Means suppose trust objective is for the education, but trust is applying that income for any other purpose, then it will be treated as a specified violation. Or second, where trust has income from business which is not incidental to attainment of its object of the trust. Means trust is having business, and that business is not incidental to attainment of the main objective of the trust. Or suppose trust is having the business for that is incidental, but separate books of accounts are not maintained by the trust. Or where the trust has applied any part of income for the private religious purpose. Means trust is having the private religious purpose, like our family member only will pray to the God, that is called private religious purpose trust. Or suppose where the trust has applied any part of its income for the benefit of any particular caste or particular community or particular religion, then it will be treated as a specified violation. Or suppose any activity of trust is not genuine or not carried out in accordance with the condition subject to which it was registered, or the trust has not complied with the requirement of any other law, because trust has to follow the other law also, like FEMA and all. But suppose trust has not complied with any other law, in that cases this is the 6th violation, that is known as the specified violation. So what is the meaning of specified violation? Here specified violation means suppose trust money is used for any other purpose other than their object. Second is where trust doing any business, but that business is not incidental to attainment of their main objective. Or suppose that is incidental, but separate books of accounts is not maintained. Trust is using the money for the private religious purpose, or trust is for a specific caste, community, religion. Or suppose trust activity is not genuine, or trust has not complied the any other law, in that particular case it will be treated as the specified violation. Then suppose a specified violation took place, then what will happen? So guys, how commissioner will come to know that a specified violation took place? So either CIT PCIT notice occurrence of a specified violation during the previous year, means CIT PCIT himself, he noticed that okay, trust did some specified violation, or the CIT PCIT has received a reference from assessing officer under the second proviso to section 143(3) for any previous year. Now what happened? Assessing officer is doing the scrutiny assessment of trust, and when assessing officer was doing the scrutiny, now that time assessing officer realized that oh, trust did the specified violation, then he will intimate to the assessing officer, sorry, he will intimate to the commissioner, CIT PCIT. Or suppose case has been selected as per the risk management strategy of the CBDT. CBDT is having the various risk management strategy, and according to that risk management strategy, suppose that case is selected, and in that case they are thinking that oh, there is a specified violation, then what CIT PCIT will do? So here CIT PCIT shall do call for such document or information and make such inquiry as he think necessary. First they will call some information, document, go okay, in true sense is there is any specified violation or not. Second, if he is satisfied that specified violation took place, then he will pass an order for cancelling the registration. If commissioner satisfied, CIT PCIT satisfied that oh, specified violation took place, then they will cancel the registration of trust after giving an opportunity of being heard for such previous year and all subsequent previous year. And if he is not satisfied about the occurrence of a specified violation, then pass an order in writing, refuse to cancel the registration. If they are not satisfied, oh, there is no specified violation, then they will pass the order, but in that order they will write that they will refuse to cancel the registration. Now, order shall be passed within 6 months from the end of the quarter in which first notice is issued by CIT PCIT calling for any document or information or making the inquiry. So guys, this order, either cancelling the registration or refuse to cancel the registration, this order has to be passed within 6 months from the end of the quarter in which that first notice is issued by CIT PCIT calling for any document or information or for making any inquiry. From the end of that quarter, within 6 months they will pass the order and forward a copy of order to the assessing officer as well as the trust. You got my point or not? Yes. Now next section is a 13(1). Now guys, 13(1) says that in the 4 cases trust is not eligible to claim the exemption under section 11 and 12. In the 4 cases, trust is not eligible to claim the exemption under section 11 and 12. First is if any trust is for private religious purpose, or any trust is for the specific caste, community, religion. And in the last point only we have discussed that if trust is for private religious purpose or a specific caste, community, religion, then guys trust registration will be cancelled by the CIT. So here lawmaker says that in section 13(1), lawmaker says that if any trust is for private religious purpose or a specific caste, community, religion, then exemption is not available. And third point says that suppose if trust money is used for the benefit of any relative of trust, or trust asset is used for the benefit of any relative of the trust, then also guys exemption will not be available. But here, like whatever part of income they have used for the purpose of benefit of relative of the trust, that part of income will be taxable in hands of trust. Means only that part of income will be taxable in hands of trust, and that income will be taxable under section 115 BBI at the rate 30%. And last point, guys, trust money, all trust money has to be deposited in section 11(5) mode only, safe investment. Otherwise, whatever money not deposited in 11(5), that amount is going to be taxable. That amount is going to be taxable under section 115 BBI at the rate 30%. So there is 4 points. Section 13(1) says that in the 4 cases 11-12 exemption is not available. One is trust for the specific caste, trust for the purpose of a specific caste, community, religion, or for the private religious purpose, or suppose trust is use money or asset for the purpose of relative. Now question is that who will be treated as relative of the trust? So first is a founder or author of the trust is a relative of trust. Second is a substantial contributor. Substantial contributor means if any person made the donation of more than 50,000 to the trust in the previous year, then that person will be treated as the substantial contributor. Now guys, if founder, author, or substantial contributor is a HUF, then all member of HUF will be treated as the relative of the trust. Last is trustee or any manager, why whatever name call, they will be treated as the relative of the trust. And guys, whatever person we have discussed here, relative of that person will also be treated as relative of the trust. And here relative means whatever we have discussed under section 56 to 10 under income from other sources, that same relative will apply here also, and they will be treated as the relative of trust. And last point says that okay, whatever person we have discussed here now, if they are having a substantial interest in any concern, then that concern will also be treated as relative of the trust. And if any benefit is given, then that benefit will be taxable in hands of the trust. Now guys, there is a one section 11(1)(a). 11(1)(a) says that okay, sir, suppose for an example, any trust sold any capital asset and there is a capital gain and they purchase another capital asset. So is capital gain will be exempted or not? Answer is yes. Here capital gain is exempted, but capital gain exempted as per some interesting formula, and that formula is okay, suppose for an example, net consideration is fully utilized, then capital gain is fully exempt. Means net consideration of old asset is fully utilized, then capital gain is fully exempt. But suppose net consideration is partly utilized, then exemption is available as per one formula, and that formula is cost of new asset minus cost of old asset. Cost of new asset minus cost of old asset, that remaining will be treated as the exemption. So what I am saying that one capital asset is sold, and guys, in that year suppose another capital asset is acquired, then capital gain will be exempted. But how capital gain will be exempted? If your net consideration is fully utilized, then capital gain is fully exempt. But net consideration is not fully utilized, then cost of new asset minus cost of old asset, cost of new asset minus cost of old asset, that remaining will be treated as exemption. Now there are three questions given, 5, 14 and 19. You will discuss that, you will study that time you will understand, don't worry. Now there is a one section 115 BBI, and this 115 BBI is a new section, and this section is introduced by the Finance Act 2022 only. Now this section says that okay, guys, there are some specific income that will be taxable at the rate flat 30%. Flat 30%, any deduction is not available directly, it will be taxable at the rate 30%. First point is, if any income accumulated or set apart in excess of 15%, where such accumulation is not allowed under any specific provision. So normally you know that 15% is a standard deduction and other accumulation are allowed by the law. But suppose some accumulation is not allowed by the law and you have accumulated any income, then that income will be taxable directly at the rate 30%. Second point, deemed income as per explanation number 1 of section 11(1). In 11(1), you know that we have discussed that explanation. Okay, like suppose any amount is not received in current year, then you have to give the declaration that we will actually apply this amount in the year in which it is received, or in the next year, then it will be treated as deemed application in current year. Suppose it is not applied in that year, in obviously that will be treated as income and it will be taxable at the rate 30%. As well as the 11(3). 11(3) means for that 5 year you have accumulated, and suppose 5 year expired, then in 5th year it will be taxable. It will be taxable at the rate 30%. One more point, if any income or any amount is applied for the relative of the trust, then whatever amount has applied, that will be taxable at the rate 30%. And guys, if any amount is not deposited in 11(5) now, then that amount will be taxable at the rate 30%. And any income used for any purpose outside India, if any income is used for the any purpose outside India, then guys, that income will be taxable at the rate 30%. Because normally in case of charitable and religious trust, that income should be applied for the charitable or religious purpose in India only. If any amount is applied outside India, then guys, that amount will be taxable at the rate 30%. Now guys, there is a one section 1310. 1310 is also new section, and this section is inserted by the Finance Act 2022. Now this section says that you know that in the first part, in the charitable purpose meaning, we have discussed that in case of advancement of any other objective or general public utility, if your commercial receipt is more than 20% of total receipt, then exemption is not available. Then exemption is not available in that year, that trust is not treated as charitable trust. So here guys, in that case, suppose if in case of advancement of any other objective or general public utility, that commercial receipt is more than 20% of total receipt, or suppose in case of the trust, if trust is not maintain the books of accounts, then exemption is not available. Or suppose trust maintain the books of accounts but books is not audited, books of accounts is not audited, or suppose trust has not filed the return on the time, then can I say that trust is not eligible for any exemption? Now only we have discussed under section 12A that trust is not eligible for exemption, either it is not registered under 12AB, or second condition that trust income is more than basic exemption, then they have to maintain the books of accounts, get it audited, they have to file the return up to the due date of return filing, otherwise exemption will not be available. So here guys, this section says that in 4 cases exemption is not available. One is commercial receipt is more than 20% of total receipt in case of advancement of any other objective or general public utility. Second point, I am saying that suppose books of accounts is not maintained. Third is books of accounts not audited, or return is not filed up to the due date of return filing. Then exemption will not be available. That 15%, 85% applied, and that will not be available. Then sir, how income will be calculated? Is total gross receipt directly will be taxable? Answer is no. Here they mention that in that case, income will be calculated, but how? Whatever gross receipt of trust minus revenue expenditure. minus only revenue expenditure incurred in India, that will be reduced, and remaining will be treated as the income of the trust. Remaining will be treated as the income of the trust. So here guys, like how income will be calculated, then trust income chargeable to tax shall be computed after allowing deduction for the expenditure, but other than capital expenditure. Capital expenditure will not be allowed, only revenue expenditure is allowed, and that too incurred in India, and for the object of the trust subject to fulfillment of following condition. Now there is a fourth condition also, that such revenue expenditure should not be spent out of the corpus of the trust. Second, such expenditure is not from the loan or borrowing or depreciation. You cannot claim when asset is already claimed as application, and such expenditure is not in form of any contribution or donation to any person. So in simple word, I can say that guys, this section says that suppose trust commercial receipt is more than 20% in case of advancement of any other objective or general public utility. Yeah? Second is books of accounts not maintained, or books of accounts not audited, or return is not filed on time, then exemption is not available. But how income will be calculated? So how income will be calculated? First take the all income minus only revenue expenditure incurred in India. But guys, if that revenue expenditure is incurred out of corpus, then that will not be allowed. Or it is incurred out of borrowed money, then it will not be allowed. If it is a donation to any other person, then it will not be allowed. Or suppose if any asset actual cost is already claimed as application in the earlier year, then depreciation will not be allowed for the computation of income. And guys, for the PGBP, that section 40A3 as well as 40A3A, 40 clause A subclause 1A, that will be allowed, as well as only this expenditure will be allowed. Other than that, only revenue expenditure is allowed, any other expenditure is not allowed, as well as any other losses you cannot set up and carry forward and all against the income if it is taxable under section 1310. You got my point or not? Yes. Now next section is related to the anonymous donation. Anonymous donation means unknown donation, like in Tirupati Balaji, that hundi donation is called anonymous donation. So guys, is anonymous donation is taxable at the rate 30%, or anonymous donation will be part of the income of the trust, and that will also be the 15%, 85% and all. That is under 1112. So lawmaker says that if anonymous donation is received by the religious trust, religious trust means all temple, gurudwara, mosque and church, then guys, that anonymous donation will be part of section 1112 only. Means that anonymous donation will be 15%, 85% applied and all. But suppose if anonymous donation is received by any charitable trust, then total anonymous donation will be taxable at flat 30%. Total anonymous donation will be taxable at the rate flat 30% under section 115 BBC. But suppose, sir, if that trust is a charitable as well as religious both, then what will happen? So here lawmaker says that if trust is a charitable or religious, in that particular case, whatever anonymous donation received towards the school or towards the hospital, that anonymous donation will be taxable under section 115 BBC at the rate 30%, but other anonymous donation will be part of the normal income, and it will be like taxable as per section 1112 only. Means it will not be taxable as per 30%. So what I am saying that normally try to understand, anonymous donation received by the religious trust, directly check 1112 section 115 BBC not applicable. But suppose anonymous donation is received by the charitable trust, then 115 BBC is applicable. If there is a charitable religious trust, in that particular case, whatever amount received towards the school or towards the hospital, that amount will be taxable under section 115 BBC, and remaining will be taxable as per section 11 and 12. Now one more point guys, total anonymous donation is not taxable at the rate 30%. Here how you have to calculate, first take the anonymous donation, and guys, out of this anonymous donation, obviously some amount can be like genuine also. So out of total anonymous donation, you have received minus 5% of total donation. Just take the 5% of total donation, and guys, here total donation include corpus donation, non-corpus donation, like government grant and also government grant and all, that all will be part of the total donation. First take the anonymous donation and minus 5% of total donation. Total donation means anonymous donation, non-anonymous donation, normal donation, corpus donation, all type of donation, a government grant also. Total donation multiplied by 5% or 1 lakh, whichever is higher, this amount you have to reduce. And guys, this remaining amount will be taxable at 30%. But question is that, okay, sir, whatever amount you are reducing here, you are like reduce here, is this amount will be like exempted? Answer is no. This amount is taxable as per normal rate. This amount will be taxable as per normal rate, means for taking the income for that 15% and all, this amount will be considered for the purpose of section 11 and 12. You got my point or not? Yes. Now next section is a 1023C. 1023C is very simple section. This section says that Guys, this section is related to the hospital university, normally hospital as well as the universities, schools and all. So here in 1023C, there is basically three part. First part is 1023C subclause number 3AB and 3AC. This point says that all government hospital and government schools, their income is totally exempted. Government hospital and government school, their income is exempted. There is no need of any registration. There is no need of any approval. Their income is totally exempted, but their motive should be the education or medical. So here this point says that income of any university or educational institution or hospital or other institution wholly and substantially financed by the government. What is the meaning of substantially financed by the government? When government grant is more than 50% of total receipt of the trust. So whatever total receipt of the trust, in that if government grant is more than 50%, I can say that it is a government hospital, substantially financed by the government. So government hospital, government university, government school, guys, which exists solely for the educational or medical purpose and not for the profit purpose, shall be fully exempt, and there is no need of any registration. There is no need of any registration. There is no need of any approval. Their income is totally exempted. Now, guys, next part is a section 1023C, 111 AD and 111 AE. This point says that if there are some small educational institution or hospital, means small colleges, small educational institution, small hospitals and all. Now, what is the meaning of small? Small means their gross receipt should be up to 5 crore in a year. Their gross receipt up to 5 crore in a year, their income is also totally exempted. Their income is also totally exempted. There is no need of approval here also. No need of registration. There is no need of registration. There is no need of approval. Their income is also totally exempted, but motive should be the education, not profit. Means it should be for the purpose of education and medical. That should be their motive or objective. Then their income is totally exempted. There is no need of any registration. But guys, here suppose one institution is having the hospital also as well as the educational institution also, and in hospital their gross receipt is 3 crore and in educational institution their gross receipt is 4 crore. Individually it is up to 5 crore, but total it's a 7 crore. Is exemption is available? Answer is no, exemption is not available, because they mention that if any person is having the educational institution, hospital also, then if total gross receipt should be up to 5 crore, then only exemption is available, otherwise exemption is not available. So we have discussed the two part. First point, government hospital, government school, their income is totally exempted. There is no need of registration also. Now second part, small hospital, small educational institution, their gross receipt up to 5 crore, their objective is education or medical, their income is also totally exempted. There is no need of any registration. Now last point says that suppose if any educational institution, hospital is not covered in this two part, then guys in the third part there are certain section, that is the 1023C clause number 4, clause number 5, clause number 6 and clause number 6A. They are saying that suppose if any educational institution or trust or charitable religious purpose, university, educational institution, hospital and all, if they are not covered here in the first two part, then they have to apply for approval to the CIT PCIT. They have to apply for approval to the CIT PCIT under section 1023C, clause number 4, clause number 5, clause number 6 or clause number 6A. And guys, you know that first 2%, their income was totally exempted. There was no need of that 15%, 85% and all. But guys, this third person, this person income will be exempted similar to section 11 and 12. Means whatever section we have discussed, 11, 12, you know, the 15%, 85%, that accumulation and all. So whatever provision we have discussed with the 11 and 12, now all provision will be applicable for this hospital and educational institution, and they should take the approval under this sections. You got my point or not? Yes. So in same way, I can say that section 1023C clause number 4, 5, 6 or 6A are similar to the 11, 12 and 13. So whatever we have discussed under 11, 12 and 13, that will be applicable for this institution. But guys, for the first two, there is not applicable. They no need of any registration also, but third part, they need of registration. Now that registration process is similar to the 12AB, whatever we have discussed in the 12AB, that is similar to the 12AB. Now guys, there are two case laws. One is the Queen's Educational Society and one is the St. Peter's Educational Society. Now what happened? Queen's Educational Society, they are having educational institution. Now they are having the educational institution and suppose their gross receipt is up to 5 crore. But what happened? They made the profit in the current year, but that profit was incidental. Their objective is not a profit. Their objective is not to make the profit, but incidentally they made the profit. Here commissioner says that no, exemption will not be available because you got the profit. Here assessee says that we got the profit, but our objective is not the profit. Our objective is a philanthropic purpose. Our objective is for education. We don't want to make the profit, but incidentally, obviously, we used to collect the fees from a student and all. We made the profit. That's why we need the exemption. So, is exemption is available or not? Answer is yes, exemption is available. Here, Supreme Court says that where assessee is engaged in imparting the education and incidentally makes the profit, which was only incidental to the main object of spreading education, and condition laid down in section 1023 C 111 AD is satisfied, hence exemption shall be allowed. There is a distinction must be drawn between the making of the surplus of an institution being carried on for the profit. Merely because imparting of education resulting in making a profit, it cannot be inferred that it become an activity for profit. Means they are not, objective is not the profit. Incidentally, they made the profit. Yes, exemption is available. Now, St. Peter's Educational Society, this case law says that, okay, what happened? This particular educational institution, they are giving the degree diploma in advertisement or communication and all. Is they can claim the exemption? Is it will be treated as education or not? Answer is yes. Education does not means only BCom or BSc or 11th 12th and all. Guys, here if they are giving the diploma degree in the communication or advertisement and all, that will be treated as education, and even they made the profit, then also they are eligible to claim the exemption under section 1023 C. You got my point or not? Yes. So this is the completion of your trust topic. So we have completed one topic, that is trust topic. Just you have to revise this topic. And guys, in trust, second part is the accreted income, or I can say that the exit tax. So exit tax we will discuss in the next part. Today we have completed the trust topic. So just you have to remember whatever provision we have discussed today, because I am expecting that this time there will be a 7-8 mark question from the trust, or either from accreted income, exit tax, or from the trust. And exit tax is very simple topic and very small topic. Okay. One more point. Many students are writing everyday message, sir, please complete the English revision lecture as soon as possible. Guys, I will complete before examination, but I cannot give you the date, sir, on day, what date it will be completed. So please cooperate with me. In Hindi, I already uploaded, and I know that you understand thoda Hindi karke, theek hai? So just try to listen other topic from the Hindi revision lecture, but before examination, I will try to complete more and more lecture in the English also. Okay. So thanks a lot, people. That's enough for today from my side. And guys, in the April, I am going to give you the super 30 question, best 30 question for your examination. Just you have to solve that question, so you can get the confidence. And in that question, you know that from the trust topic, I have incorporated various amendment also. So whenever you will do the trust topic now, that trust question from that super 30, that is very amazing question and nice question. You will feel like that, okay, we have covered the various amendment in that question. So thanks a lot, people. That's enough for today from my side. See you in the next lecture. Bye.